Hey there, and welcome to This Explainer. If you're tuning in today, chances are you're in a pretty great place in life. You're a professional, maybe in your late 20s, navigating your career, and you finally hit that fantastic milestone. You actually have some disposable income. But now comes the really big question. Do you just hold on to that cash, let it sit there in a checking account, and maybe spend it on things you don't really need? Or do you take control, intentionally transform that extra cash, and purposefully build long-term wealth? Well, today we're going to explore exactly how to do the latter by diving into these insights together. Okay, let's dive into this. Here's our roadmap for today. We're going to cover 1. The Appleseed strategy, 2. The major asset classes, 3. The risk-return pyramid, 4. Understanding CAPM and beta, 5. The diversification rule, and finally, 6. Your long-term action plan. All right, part 1. The Appleseed strategy. So, as a young professional, having extra cash creates this fascinating dilemma. You work hard for your money, right? So the temptation to just spend it right now is incredibly strong. But here's the catch. With inflation constantly chipping away at the purchasing power of your cash, doing absolutely nothing is actually a guaranteed way to lose value over time. And that brings us to our core definition today, investing. Instead of spending your money immediately, you use it to buy an asset today, expecting it to appreciate or produce income in the future. I want you to think of your disposable income as apple seeds. You could eat the seeds right now, sure, but they wouldn't be very satisfying. However, if you plant them in fertile soil, water them, and wait patiently, each one of those seeds can grow into a massive tree that produces baskets of apples year after year. Investing is simply planting your financial seeds today to outpace inflation and harvest the growth later on. Moving right along to Section 2, the major asset classes. Let's see how this actually works out in the real world. We need to look at the actual financial seeds available to you as an investor, because each tool has a completely different way of making you money. The two most fundamental seeds you'll come across are stocks and bonds. When you buy stocks, you're buying ownership. You literally become a partial owner of a company. If they do well, your piece becomes more valuable, and you might even get a share of the profits, which we call dividends. But it's higher risk. If the company struggles, your shares drop in value. Bonds, on the other hand, well, they're simply IOUs. You're lending your money to a company or a government. In return, they promise to pay you back your original amount plus fixed interest. It's a loan, which naturally makes it a much lower risk profile compared to owning a piece of a business. Now, beyond individual stocks and bonds, we have tools that bundle them all together. Mutual funds pool money from thousands of investors, and they're managed by a professional who picks what they think are the absolute best assets. Then there are ETFs, or exchange-traded funds. Think of an ETF like buying an entire animal sticker book all at once, rather than trying to pick the one coolest dinosaur sticker at the store. You get instant variety and broad exposure to the whole market in one shot. Finally, there's real estate, owning physical property where you make money through monthly rental income and, of course, the long-term appreciation of the property's value. So, you know what the seeds are now, but here is the ultimate question every investor has to ask themselves. How much risk is actually worth taking with your hard-earned money? This perfectly pivots us from the basic tools to the underlying financial physics that actually govern them. Which brings us to Section 3, the risk-return pyramid. In finance, there's a pretty fundamental rule. The bigger the potential treasure, the scarier the mountain you have to climb to get it. We visualize this as a pyramid. At the wide, stable bottom, you have your ultra-safe assets, cash in the bank and government bonds. You won't lose your money, but your returns are basically going to just barely beat inflation. As you climb up into the middle layers, you find moderate risk and moderate return. Things like real estate and those broad stock ETFs we talked about. And at the very top of the pyramid, high-risk, speculative assets like individual startup stocks or crypto. They offer the absolute highest potential returns, but the base is narrow, and man, the fall is steep. Now, what's really interesting about this slide is the specific phrase, in a sense, fallacious. It is a crucial caveat that trips up a lot of young investors. Look, climbing the dangerous mountain doesn't actually promise you gold to the top. Taking high risk only opens the door to a chance at higher returns. If you buy a highly volatile stock, the market absolutely does not owe you 20% return just because you took a big risk. You might just lose everything. Risk is a prerequisite for high reward, for sure, but it is not a guarantee of it. All right, part 4. Understanding CAPM and beta. So how do professionals actually weigh this risk versus reward? Well, they use a sort of secret decoder ring called the Capital Asset Pricing Model, or CAPM for short. Here's the math, but don't let it intimidate you. It's actually pretty straightforward. Expected return equals the risk-free rate plus beta multiplied by the market risk premium. The crucial point here is that investors demand a baseline reward just for parting with their money. That's the risk-free rate, usually a super safe government bond. Then they demand an extra reward for being in the stock market at all. Finally, they multiply that extra reward by the specific risk of the asset they're buying. That's specific risk multiplier. We call that beta. The overall market has a beta of exactly 1.0. If you buy a stock with a beta of 0.5, it's like a large, slow, steady ship. If the market drops 10%, your stock might only drop 5%. But if you buy a stock with a beta of 1.5, you are in a choppy speedboat. It amplifies every single wave. If the market goes up 10%, you might shoot up 15%. But if the market crashes, you are going down hard. Let's actually look at some real-world data together from a recent 2-year window. We're assuming a 4% risk-free rate and a 10% market return here. See Microsoft? It has a low beta of 0.9. CAPM mathematically expects a 9.4% return, but it actually delivered 12%. Apple, slightly riskier with a 1.3 beta, was expected to return 11.8%, but delivered a massive 20%. Both of these generated what Wall Street calls alpha, meaning they beat the mathematical expectations. But look at Tesla, a highly volatile speedboat with a 1.9 beta. CAPM says you should absolutely demand a 15.4% return for taking on that much stress, but it only delivered 10%. It totally underperformed its risk profile. Moving on to Section 5, the diversification rule. Since calculating precise risk and return is, frankly, totally imperfect in the real world, we have to protect ourselves. And we do this using a golden rule. Don't put all your eggs in one basket. We've all heard it, right? But did you know it actually dates back to Miguel de Cervantes in his 1605 masterpiece, Don Quixote? Now, the famous industrialist Andrew Carnegie gave the exact opposite advice. He said, put all your eggs in one basket and then watch that basket. But let's be real, unless you're a 19th century steel magnate dedicating 24 hours a day to one single business, Cervantes is right. Spreading your investments across different assets is literally the only proven mathematical way to mitigate disaster. And finally, Section 6, your long-term action plan. All right, it is time to transition from abstract models into a highly specific blueprint for your own money. And this brilliantly illustrates our ultimate balanced portfolio for a young professional looking to grow wealth while surviving inevitable market crashes. Check out this allocation. 50% in a broad stock index. This is your growth engine, capturing the innovation of the entire world. 25% in bonds, specifically including non-US bonds for currency diversification. Think of this as your shock absorber when stocks inevitably dip. 15% in real estate, likely through a REIT, providing you with steady rental income and a great inflation hedge. And finally, 10% in precious metals like gold. This is your portfolio insurance, an asset that has intrinsic value and often rises when everything else is falling. Okay, so what are your immediate actionable steps today? Number 1. Open a brokerage account online. Seriously, it takes like 10 minutes. Number 2, buy diversified funds like an S&P 500 ETF or a global bond fund, rather than trying to pick the next Apple or Tesla. And number 3, this is huge. Prioritize time in the market. Do not try to perfectly time the market by guessing when it will crash. Consistent monthly investing over decades is vastly superior to timing. Which leaves us with one final, really vital thought. You know the tools, you understand the risk, and you've got the blueprint. So, are you ready to plant your first apple seed today and watch your future wealth grow? You know, they say the best time to start investing was yesterday, but the second best time? That's right now. Thanks so much for exploring this with me on today's Explainer, and I'll catch you in the next one.